Interested in learning about price to earnings ratio? This metric, also known as PE ratio, gives investors a quick valuation of a stock. It's a very common metric that helps you understand if the company is currently over or undervalued in the market. Hey, welcome to Rynance, the channel centered around your financial education to help make you a better investor. Be sure to subscribe to the channel as I upload new educational stock market videos every week. PE ratio is a valuation metric that compares the stock's current price to its earnings or profit. It tells you how much of a premium you are currently paying in order to gain exposure to that company's profits. The price to earnings ratio can be used to help understand whether the market is currently placing a high or low price on that stock based on how much money and profits the company is generating. In general, stocks with a low PE ratio, something around 10, would imply the stock is currently cheap, whereas stocks with a high PE ratio, say 50 or greater, implies the price is currently expensive relative to the profit that it makes. Let's have a look at how you can calculate the PE ratio. The formula is the price per share divided by the earnings per share. If you haven't already seen my video on earnings per share, or EPS, you can check out the link to the video on screen now to get a better understanding of earnings per share. The output from the PE ratio calculation will result in what's called a multiple, something like 20 times. If you ever hear somebody referring to a stock's multiple or earnings multiple, this is what they are talking about. So now let's do a quick example here. A hypothetical company, Bill's Bike Shop, currently has a stock price of $60 per share and has an earnings per share of $3. To find the PE ratio, we divide $60 by $3 to find that Bill's Bike Shop has a price to earnings ratio of 20 times. What this is telling us is that the market is currently valuing the shares of Bill's Bike Shop at 20 times the amount of their yearly profit. So if you were to buy shares in Bill's Bike Shop, you would be paying 20 times the amount that they generate in profit for the year. This ratio also implies that it would take 20 years at current price and profit levels for Bill's Bike Shop to make enough money to pay back all the shareholders in full for their shares. PE ratio really shows its strength when you use it to compare different companies within the same industry to get a better idea of how each company is being valued. Let's compare two companies here, Bill's Bike Shop and Sam's Scooter Company, both of which provide alternative means to transportation, so we can consider them to be in the same industry. From before, we already know that Bill's company has a price per share of $60 and an earnings per share of $3, giving us a PE ratio of 20 times. Now for Sam's Scooter Company, they currently have a price per share of $75 with an earnings per share of $5. You may be inclined to think that Bill's Bike Shop is a better value because the share price is only $60 versus the $75 for Sam's Scooter Company, but share price alone does not tell the full story. When we calculate the price to earnings ratio for Sam Scooters, we find that the stock has a PE ratio of 15 times. So what's going on here? Even though Sam Scooters has a higher price per share, they are also generating more earnings for the shares outstanding. What we see is that when we compare the two companies in an apples to apples sense with PE ratio, we find that Sam's shares are actually of better value since the company is more profitable. Even though Sam's Scooter shares are $15 more expensive, they actually give you the right to more profits than Bill's Bike Shop does. You have the right to $5 per share worth of profit instead of only the $3 per share in profit that Bill's Bike Shop offers. This is really the key to understanding what PE ratio tells us. You should know that the price to earnings ratio is really only useful when comparing companies within the same industry, as different industries will have different standards when it comes to PE ratio. It would not make sense to compare McDonald's PE ratio to Amazon's PE ratio, for example. This is because expectations and growth rates within the restaurant sector, like McDonald's, are very different than the expectations for a technology company like Amazon. McDonald's might see more consistent profits, but at a lower growth rate, whereas Amazon's profits are expected to grow much faster, but have the potential for volatility. It would be a much better idea to compare Amazon's PE ratio to another tech company, like Apple, to get an idea on the valuation of each of those companies. With that being said, remember that using PE ratio for comparison is really only useful for companies that operate in similar markets and similar industries. Finally, let's have a look at where we can find PE ratio without doing any of the math. My go-to source for stock information is Yahoo Finance, but you can use whichever platform you like best. We have McDonald's stock here on Yahoo Finance, and we want to look at the financial metrics section to the left of the chart. We can see that PE ratio is listed here, telling us that McDonald's stock currently has a PE ratio of about 37. So if you were to buy McDonald's stock today, the stock price would be 37 times larger than the amount of profit that the company makes. Thanks for watching today. How do you use PE ratio to evaluate a company? Let me know your process in the comments below. You can check out the playlist on screen now for more educational videos like this one. If you found the video helpful, give it a thumbs up. And as always, subscribe for more, and I'll see you in the next one.